Good afternoon, everyone, and welcome to Skilled Nursing M&A in 2023 and beyond. A few administrative details before we begin. If you experience any technical difficulties with today's webinar, please contact Irving Levin's customer service at 203-846-6800, or you can email us at info@levinassociates.com. At any point during the webinar, you can enter your questions for our panelists in the Q&A box, and we will do our best to address them during the webinar. If not, we can reach out to you afterwards with our answers. Lastly, at the end of today's webinar, a survey will appear. Any feedback is greatly appreciated and will be used to improve our future webinars, and it will also help inform our next topics. And today's webinar is sponsored by NewPoint Real Estate Capital. You can go to the next slide. NewPoint is a leading lender offering HUD, FHA, agency, and proprietary solutions to owners and operators of seniors housing and healthcare properties nationwide. Thank you to them for the sponsorship, and also thank you to NewPoint's Erik Lindenauer for joining today's panel. Erik is the president of FHA at NewPoint and oversees the FHA multifamily and healthcare origination and servicing operations for the firm. And we just have to say that it was just revealed that NewPoint ranked second in HUD lien deals closed and dollar volume in its last fiscal year. So congratulations, Erik, on that. And previously, he was the executive chairman of HHC Finance, which merged this business into NewPoint at the end of 2021. He brings more than 25 years of experience in the mortgage and investment banking world, and I'm very happy to have him on. Welcome, Erik.
Thank you. Good to be here.
And next, we have Akash Vipani from Blueprint. He joined the firm in 2017 and helps oversee the development of valuation analyses, but he's also kind of grown into the skilled nursing specialist there. And I just want to quote Ben Firestone, who said, "Everything SNF at Blueprint runs through Akash." So obviously, it's great to have you on today, Akash.
Yeah, thanks, Ben. Great to be on.
And finally, we have Marc Halpert. He's the CEO of Monarch Healthcare Management. And since acquiring their first facilities in 2015, Monarch has grown to a portfolio of about 60 facilities in Minnesota. And Marc has been in the healthcare industry for 20 years, going from admissions director to administrator to VP of business development and now to CEO. So it's great to kind of have that full experience on this panel. And thanks for joining, Marc.
Of course, happy to be here.
And we have a lot to get to within the hour, as you can see with our agenda here. So let's just dive in. Most would describe the period from 2021 as a sort of peak of SNF M&A. And I mean that in terms of activity, buyer interest, and certainly valuations. And I think back to ECAP 2022, kind of as the high point, where the mood at ECAP was, I guess, exuberant to say the least. And if we just go to the next slide to see that activity actually play out in our Levin Pro LTC statistics, it shows that activity and definitely dollar volume peaked in 2022. So Erik, I'll start with you. Can you just tell me what exactly motivated buyers to acquire so many SNFs at such high prices around that time?
Yeah, it was a really frothy market and a lot of activity. And really, I attribute it to not one thing, but numerous things. Obviously, we were, just coming out of COVID around that time. And a lot of mom and pop operators kind of were having a difficult time, and they just wanted to sell because they weren't set up to or have the liquidity to deal with those bumps in the road. And large corporations, large public companies were having a hard time with their portfolios overall, and they also were looking to sell. So when you have that combined with absurdly low interest rates that we've never seen before. I think the 10-year Treasury had gotten to, less than, about 0.5%. You had that factor. There was no lack of capital. People, a lot of banks were just wanting to get into business. So banks were just jumping in they saw this party train going on and they wanted to be a part of it. There was a lot of excess liquidity in the market. Investors had money. They were looking for good returns. Skilled nursing, you're buying at a 12 to 13 cap versus multifamilies, which are down at a 3 cap. So a lot of investors were throwing money into the skilled nursing space, some blindly, some with their eyes wide open. And also, a lot of people have seen the success of the overall market and the overall profitability of this business, and they also wanted to kind of become a part of it. So it was, I think, all of those issues created a very frothy market, and everyone driving prices and jumping to get in.
And Marc, would you have anything to add to that as kind of someone who was involved as a buyer?
Yeah, I mean, definitely took all of my notes off my page here. The interesting piece, along with obviously low interest rates and the excitement of for a decade already, that I need to be in nursing homes, I need to own to make some money, has been exciting, and it definitely continues to grow. One of the things that I saw at the beginning of COVID in 2020 and 2021 were this fear of how are nursing homes going to survive. And the big conversation toward once the vaccines came out and starting to see the light at the end of the tunnel was, if I can hold on for 5 more years, this is going to be awesome. And with the interest rates low and homes for sale, people were willing to pay those extra dollars in order to get the homes to build, to add to their portfolio. Monarch sure did, and it's paying off, because you're right, the facilities are, people need a place to go. Baby boomers are still coming toward us. So we're looking at not just today and tomorrow, but 5 years from now and 10 years from now, and to get in now and to stabilize. And this is really true for 2 years ago and last year, really has led to a high purchase in 2021 and 2022. And just the excitement of continuing to grow for a lot of operators.
And Akash, what type of facilities did you see were the most popular acquisition targets during that time?
Yeah, I would say that a lot of the most popular acquisition targets during that time frame, were facilities that had decent revenue and expenses, decent revenues and census, but had expenses out of control, right? So I think the easiest path to profitability is coming in, reducing expenses day one. And we saw that a lot of the facilities that were targets had expenses be the biggest problem. And, a lot of facilities that fit that bucket were, nonprofit facilities or, larger health systems spinning off their skilled nursing facilities.
And then the buyers that were kind of swooping in and acquiring these facilities, Erik, who were those buyers? And did that change based on the facility type? Like a certain cohort of buyers were targeting the old and struggling facilities versus another cohort that were targeting the more profitable ones?
I think so. There's 2 questions. I believe that most of the buyers were proprietary private companies, small, kind of the size of Monarch. Like I said before, the really small owners and operators that own between 1 and 5, they didn't have the liquidity to deal with this, the drop in census and the acquisition of all the PPE, and before kind of they received stimulus from the federal government and these PPP loans to help them out. So and also the large owners were selling. So really they were pushed out, and you kind of had all the private proprietary businesses, mid-size, I think, owners. And what was the other question?
Oh, and did the cohort of buyers change based on the kind of quality of the facility? Like, was a certain group of buyers targeting the more value add transactions?
So look, I think that most of the facilities that were being sold were those that were value add, right? If you had a facility that was profitable and was still firing in all cylinders and still was able to maintain a good quality mix, I don't know that owners would have necessarily wanted to sell that, because they wouldn't have had to do that. So I think the asset class was, more of a turnaround, struggling, a drop in census, maybe an outbreak of COVID and where it needed some real capital to keep things going. So I think that was a facility type mostly that was available, and you had to have the buyer with the foresight to and the liquidity and the foresight to say, like Marc had said before, this is going to cost me for the next couple of, year, 2 years, I'm going to have to put a lot of money into this, but in 4 or 5 years, this is going to be a diamond.
Mhm. I would say, kind of as a segue into our next section, talking about valuations, that some of those owners of the most profitable facilities may have been lured into the M&A space just because of the high valuations that they were seeing on the market. And, if you could get out at a basis of $200,000 a bed, which we saw a number of times, then that could have seemed attractive to some of them.
Correct. And like I said, some of the larger companies, like private, either funded by private equity or public companies, saw an opportunity to get out at a great return and not have to put money into the facilities on an ongoing basis.
Well, let's move on to the next slide, which shows a couple of our valuation stats. And these statistics are calculated based on our proprietary data, which includes all of the publicly available information on skilled nursing facility sales that have closed in the US that were arm's length transactions, but also include a lot of confidential information that we get on the pricing of these deals and the valuation metrics surrounding them. So as you can see here, the average price per bed steadily increased throughout the course of the century, peaking at about $114,000 per bed in 2022. When we previously had never surpassed an average of $100,000 per bed. That has fallen to about $107,000 per bed in the 4 quarters ended in June. And based on the transactions that we have seen so far this year, I would expect that calendar year 2023 would be significantly lower than 2022. But Akash, we saw the average prices rise to these record highs. What was there another factor other than supply and demand cause for this average to hit its peak?
Yeah, it's a great question. I think it was a combination of a few factors. The first was, the receipt of stimulus funds going into that period. A lot of operators and investors had cash on hand to deploy. So that was, part of that reason. I also think, after COVID, you saw a lot of states increase their Medicaid budgets as well. And you saw some of these Medicaid rate increases pass through. And then more specifically, you saw a lot of Medicaid rate add-ons as well, especially if your facilities were treating COVID patients or were COVID positive, right? So that led to a lot of acquisition activity as well as, higher prices. So I would say that was probably the biggest driver of pricing there. But I would also say there's also been a lot of new entrants into the space, just given the return profile you can get with skilled nursing facilities. And that just led to a more competitive buyer pool as well.
Marc, would you have anything to add on perhaps other factors for the both buyer interest and the rise in valuations?
For sure. I think that as we're talking about for 2021 and 2022, how, there were so many acquisitions and these crazy high prices. One of the things that I saw as an operator was a home that normally maybe in 2018, 2019, I'd be the only bidder on, and I wasn't trying to get, that there was a lot more competition out there that was outbidding me, and it was a bidding war. And, Akash and could definitely talk from the blueprint side of how that process goes, but it's definitely, that definitely impacted us. And from the partners at Monarch, having numerous conversations of, okay, we really value this at a $15 million deal. We know that this person is going to be offering 17 million. Are we comfortable going to 18 million to get this deal done? And a lot of times that answer is yes. And that, really increased the market and unfortunately led us to the situation we're in now, where prices are just sky high. As we see in the slide here, that in 2023, it's starting to come down. I know we're going to be talking about the interest rates in a little bit. I think that's really where it comes down to, where, hey, I was comfortable paying that 17, 18% when the interest was 3, 4, 5, 6%. When it becomes 7, 8, 9, 10, that game starts changing at some point. And I don't know where that happy medium is, but with Monarch, we definitely have been looking at that for quite a while, saying we don't want the competition. So it's not just we want the home, we don't want the competition. And I think a lot of other operators that same way. That's led to really the high price back in 2021 and 2022, and just kind of the averages to continue to rise.
And Tosh, kind of a follow-up question. With all those bidding wars, for buyers to justify the kinds of increases that they were willing to, support to get the facility, we had heard a number of times that, there's a lot of value in adding more and more SNF beds to your portfolio so that your ancillary businesses could then be a lot more profitable. And, that's another benefit of scale. Did you see that as kind of some reasoning there?
Yeah, I actually did. I think that's another big driver of value there is a lot of these investors and operators over the past few years have really invested in developing their ancillary businesses, your therapy companies, rehab companies, your dietary companies, right? And, adding more nursing homes to their portfolio, even if you're, paying a higher price and your return is lower, you're still making money on your ancillary business lines as well, right? So I think that just drove the will to really acquire nursing homes, just to grow the ancillary businesses as well. So that's definitely something that we've seen over the past few years, and we continue to see that today.
And Erik, did you see values rise for all types and qualities of facilities during this time as well? Like even for those struggling facilities, perhaps because of that buyer, seller, supply and demand dynamic?
I kept wondering, okay, this is the peak, and it kept going and going and going. I'm sitting here like scratching my head, like, people are paying $120,000, $130,000 a bed for a facility that's losing millions of dollars a year. And I'm sitting here like, and it's like, and people, as long as there was liquidity in the market and people were able to get financing, operators always think that they can do better than the existing people. And so it just kept going. It's like a rocket ship, it's kind of like where rates are going today. There's just no end to it. It keeps going up and up, and I'm waiting for it to stop, and it doesn't stop.
You and me both.
Well, we'll touch on this a little bit later about how maybe some of those buyers that finance those deals with, low interest rate debt at that time, low interest rate bridge debt. And we'll see how they're doing right now if they were expecting a HUD takeout at a much lower rate. But I want to move on to the cap rates. Marc, we can see here in the graph that cap rates pretty much for about 15 years up until the pandemic stayed within that 12 to 13% level. But then post-pandemic, we saw the average decrease hit a low at 11.3% in 2021. It's ticked up to 11.7% in Q4. This all comes at a time of arguably increased risk of operating in the skilled nursing environment and higher interest rates, especially in 2023. But what do you think mattered more to buyers and sellers in this market? And by this market, I mean in 2021, 2022, when things were at its peak. Were they looking at cap rate or were they looking at per bed price?
So the answer, in my opinion, is actually both, and it depended on the size of the facility. A lot of times, there's a lot of facilities that are smaller facilities that, if you look at a price per bed, the dollar amount is never going to get there. The seller just wants too much money. But if you look at it from the cap rate standpoint, okay, we could justify this. From bridge lenders to even HUD, they're looking at cap rates. And they're looking at where you're going to be. So we have to change our philosophy. I could talk to a bank all day about average price per beds, and this falls right into that area. And they're going to say, we're not going to finance you at that number. So I think it depends on the deal. Both of them have mattered, some more than others, and it's definitely fluctuated over the last few years, back and forth. When I look at it the price per bed. My business partner, William, who's our CFO, looks at it as the cap rate, and we flip-flop from time to time. So I really do believe that both matter. And especially when making an official bid and an offer to a facility, in our heads, we have an answer of what it's worth per bed and what it's worth at a cap rate base as we provide our offer.
Mm-hmm. Well, let's have Akash break the tie. Akash, are cap rates still relevant to you, or are you seeing them as still terribly relevant in the market? And if so, will they increase, decrease, or stay the same in 2024?
Sure. Well, just to make one more point on what Marc said, I think the buyer, whoever's buying it, it really depends on who's buying it, right? Your REIT buyers are going to look at cap rates and care less about your price per bed rather than your owner operators, right? So I think looking at it from the standpoint of who's buying this and what do they care about matters as well. But I would say in general, right, to answer your second question, I would say cap rates in today's market aren't as relevant overall, but at the same time, it really depends on the deal profile and the story, right? A lot of the facilities that are selling today aren't, stabilized. So cap rates don't really matter in that scenario, unless you're looking at, a forward cap rate when buyers are thinking about their exit, right? What does HUD look at, right? They're looking at their exit value for a HUD takeout. And in that scenario, your forward cap rate would matter. But when talking about, your more stabilized facilities, I'd say cap rates do matter, but not as much on a national scale. I've seen greater disparity in cap rate trends across different markets, right? Over the past few years. And, for example, right, if you're looking at a cash flowing nursing home in Southeast Florida, you're probably, trading closer to a 10 cap, just given the demand for that market. But when you compare that to a cash flowing nursing home and, a smaller cash flowing nursing home and call it rural Iowa, your cap rates are probably, 13 to 14%. So I think overall there's been greater disparity from the mean in terms of cap rates dependent on the market.
Mm-hmm. Now, the great points. And I just want to bring up that for our average cap rate in this graph here, it's only including market cap rates. So those non-stabilized deals, SNFs losing money, those are obviously not included in the average. And so the average price per bed, which does include those sales of struggling facilities, it's not an exact correlation between our average price per bed here and our trend in average cap rate. So just wanted to note that. And Akash, we had an audience question that if you wouldn't mind taking, can you comment on the valuation of SNFs for owned real estate versus leased?
Owned real estate versus leased? Yeah, so I would say if you're selling both the real estate and the ops versus just selling your operations, you're likely to probably obtain more value. Is that what you're asking in terms of the valuation between selling ops and real estate versus just the operations subject to a lease?
Perhaps what is the difference in value between the value of the real estate versus the value of the operations?
Yeah, so I would say when you're valuing the real estate, right? If it's subject to an existing covering lease with a good credit behind it, you're likely to apply a market lease yield to whatever your contractual rent payment is, right? Especially if that lease is not in default, it's covering at, call it a 1.415 coverage ratio. You can apply a market lease yield to that rent to derive the value of the real estate. When you're looking at the value of operations, I think it depends, market to market. But I would say if your EBITDA is well above what you're paying in rent and you're willing to sell that position, that's something that we've seen a lot of operators do as well.
All right, great. Well, let's move on to the lending environment. Erik, we've touched on bits and pieces of this so far, but could you just describe the lending environment during that 2021, 2022 phase? What were the typical rates seen? What were the terms like? What was the typical loan to value that you were seeing on the M&A market?
All you had to do was stick out your hand and say, I want 100% financing, and you almost got it. It was a very unique time. Listen, first mortgages like banks and FinCos who weren't going up above that, they were easily getting to 80%. And, LIBOR was at 25 basis points or around there. It was very, very low. So, and the spread to that, depending on recourse, non-recourse, partial recourse, and a variety of things, banks were loaning 300 to 400 over LIBOR. So you could be in at 3.5%. And then you could get mezz on top of that. And almost every single buyer was demanding mezz, and easily 85, 90. And I know deals that were financed at 105, 110% of the acquisition cost. So they not only were they were covering 100% of the costs to acquire, but they were funding monies for the next 6 months of working capital. And that's how kind of aggressive the lending world became. Mezz, between 80, I think, but though on average, people were going up to 90%. That was kind of the market. And mezz was anywhere as low as 11% to 14%. And
Is
then,
it a silly
you know,
question to ask how that has all changed in 2023?
no, for sure it's not. First of all, a lot of banks stopped lending. They've exited. Some FinCos have exited as well. First mortgage lenders are now lending, 65%, maybe some people will go up to 75%. And now you're based off of SOFR, which is, I think, 5.25, 5.30. So your base rate is, 5.25. And then the spread hasn't really changed that much. You're still call it now 325 to 425 over. But, you're looking at 9-10% for your first mortgage rate, which is up to 65-75%. And then if you're find a mezz lender on top of that, they're going to be probably 15% today, and they may go up to 80, maybe 85%, but I don't know anyone that's really going above 85% unless you have a fantastic relationship. And that, 550 over SOFR. So it's definitely changed. And they're also a lot more selective. And, they're going to be banks and other lenders. They're going to want to look at your balance sheets. They're going to want to make sure that you have enough cash in the bank to get you through a facility that's losing money. And they're also going to want, at least a 1.0 coverage. Before they didn't care if there was no debt service coverage and you could be losing money. I think a lot of banks are asking for some in-place cash flow and very strong personal balance sheets.
What about those facilities with no in-place cash flow?
Yeah, they're tough to finance right now.
Who is lending to those types of transactions?
So on those deals, it's really relationship driven, and you're dealing with FinCos, and you're going to be paying a lot of money for your loan, and you got to figure, is it worth it that I want to take over this facility, which is burning interest? It may not be worth it. And but there's still buyers out there. People still believe in the product, and they believe in the market.
And Marc, how has the current refinancing market and the types of rates that you can get from HUD and the terms, how has that changed, I guess, your M&A strategies and valuations today?
Well, for starters, there's homes that we've purchased previously with low interest rates, and now they skyrocketed. So as a former administrator, I can hear myself screaming at the owner of the company saying, I paid $12,000 a month in rent on my financials, and now all of a sudden you're making it $35,000 just so you can go refinance. I just feel really bad about that situation, and I'm not taking any more money from it. So it's really difficult to go down that path. But some of the loans you have to refinance. Going to HUD is obviously the preference. At least that's for how Monarch has taken the approach to get that cheaper financing. And it's just a long and lengthy process that is exhausting sometimes. I'm sure it's even more exhausting for Erik and his team and some other groups.
I used to have a lot more hair before I started with HUD.
I used to have a lot more hair before I joined healthcare. But so listen, when you're buying a home, when you're buying a house that you're living in, you're looking at a 30-year fixed rate. You never think about that interest until your buddy tells you, hey, you should refinance your house because the interest rates have gone down. Similar thought with healthcare. We have homes that we bought in the last year at high, and we're hoping that those interest rates come down so we can refinance there, or of course go down the HUD route. It's really difficult. It's when you see those interest rates staring at you in the face, knowing that you were a lower rate when you bought the facility is really scary. At the opposition, I remember when we first started in 2015, 2016, I didn't know. I was a previous administrator, vice president of business development. I didn't know how the refinancing game worked. I didn't understand that whole, why would someone do that? And when we did that with a few deals before even going to HUD, to see how you can release some money and really reinvest in the facilities has led us to a lot of success. And that was very easy because interest rates were pretty stable. In fact, they were dropping. And then, of course, now with the increase, it's really scary to look at that refinance in this market.
Yeah, I mean, it was great while it lasted. It was almost like too easy of a process.
Yeah.
But Akash, would you have anything to add on how the current refinancing market has changed M&A strategies from what you've seen?
Yeah. So one thing that we're seeing, on our side is a lot of groups that were considering a refinance are now thinking, well, should I refinance or should I just sell? A lot of groups are considering, how much cash and leverage can I pull out? What my cap gains would be if and comparing to what my cap gains would be if I actually sold, right? And a lot of groups are also thinking about, okay, let's say I do refinance, can I cover, the much higher debt service in today's interest rate environment? But overall, what we're seeing is a lot of groups just electing to sell, especially if they don't think they can improve the cash flow materially in a short period of time.
And Erik, what do buyers have to be aware of now when considering a HUD refinance these days?
So there's a number of things. One, there's if your deal is a quick turnaround, meaning you bought it 12 months ago or within the last 2 years, and you turned it around really quick, there's going to be extra scrutiny. People are looking, they're looking hard at those that want a 100% of the capital stack to be refinanced, meaning people are buying, they're getting first mortgage financing, and then they're putting in their equity as partnership debt. That's taking additional scrutiny, and they will require additional credit enhancements such as debt service reserves. If it's a turnaround, you need to be prepared to show that you have turnaround experience, even local turnaround experience in that state. Some other points that borrowers who want to go to HUD need to be conscious of these days is keep vigilant about your trailing 12-month financials. HUD, like Marc, you pointed out, it's a long process. And if your EBITDA starts dropping, and HUD's going to ask for a most recent trailing 12, and you've lost $100,000 of NOI, it's going to affect your desired proceeds. Quality of care, even if you're working to improve clinical performance or inherited a poor score from a previous operator, and it hasn't dropped off yet, that has not dropped off, HUD may require a debt service reserve tied to quality of care, and they want to see if you're less than a 3-star, they may have you do additional risk assessments and other debt service reserves. A couple other things in terms of debt allocation, HUD requires typically by a value allocation, and the thought that HUD will dramatically.
Sorry, Erik, you cut out just for a second there. Do you mind just restarting?
Yeah, no problem. I'm having internet connectivity issues. I was just talking about debt allocation, and that HUD requires that all assets in a loan portfolio have their fair share of the debt allocated by value typically. And the idea, the thought that HUD will deleverage a portfolio and leave an underlevered portfolio or unencumbered assets behind is not necessarily accurate. So let's say you had 10 facilities and you had $100 million. You can't put $100 million on 8 facilities and leave the other 2 unencumbered. HUD no longer will allow that. So there has to be some allocated debt to that. And then also HUD is very focused on escrows and reserves that are held at the existing lender. Specifically, they're very focused on sinking funds against the outstanding loan balance. And so obviously what needs to be done is that any escrows or any sinking funds that are out there have to be released prior to submission into HUD. Otherwise, HUD is going to net those proceeds from your final loan amount.
Great, very informative. Akash, there was a audience question directed to you. How much additional buyer interest is generated if existing HUD insured debt is assumable?
A lot more. I would say in today's environment, if if you're looking at a facility and it has assumable HUD debt, call it in the low interest rate environment of call it 3 to 4%. I would say that's an ideal candidate in today's market for acquisition. If someone can come in, assume that HUD debt at a solid leverage point, and acquire that facility with minimum down, that's the ideal story. And that's a lot of times that's what's driving the value of the facilities where without that HUD debt, assumable HUD debt, the value is actually lower. But when you have that assumable HUD debt, people are willing to pay a little more so they don't have to deal with obtaining acquisition financing at a higher rate and going through that process when they can just assume the HUD debt and put down minimal equity. It's a great question.
HUD is
Thank you, audience.
requiring these days typically some sort of debt service escrow on TPAs, they're called, transfer of physical assets. So when a new ownership comes in, there is a process of review and it still takes time. And the existing HUD lender has to be the one that processes that. And so they'll put together an application, submit it to HUD, and HUD will review it, and it's going to have to look at the mortgage credit. But we've seen a HUD mandate that they're going to want, with a change of ownership, a debt service reserve as well.
And how long or arduous of a process is that, would you say, Erik?
You know, I'm going to put it back on the buyer and how quickly can they get us and HUD the operating agreements, the resumes. You know, HUD is you know, it's a lot of forms, and it's how quickly can they turn around their you know, their projections and so on, their experience. You know, once we have everything, it should take a lender. You know, we still as a lender have to put together a narrative. It's a lot of work. And we don't get paid for it, but we do it as a service. You know, there's no, you know, we're not making a new loan, so there's no origination fees. And we submit it to HUD, and then it's on the asset management side of things. So they're different than production, right? Production's goal is to get new deals going, and they have production hurdles to hit, and they're a great group of people. And on the asset management side, they have to decide, are we okay with the new credit risk? And, you know, we like the way this building's been operating. And so, but it should ultimately get done. And, you know, it could take us anywhere. If it's a real crisis, you get an emergency approval in 30 to 45 days. And depending on everything else, it could take 6 months sometimes.
And Erik, we just got an audience question. How much better are HUD interest rates than alternative loans now?
So, yep. So that's a great question. So obviously HUD, you have 35-year fixed rate, non-recourse, right? So all of that is a benefit versus shorter term 1 to 3-year loans, which are floating or capped out. But HUD rates today, you know, unfortunately, the 10-year treasury is at, I think, 490-ish, mid 490s. And so HUD rates today are in the mid 6.5%-ish range, 6.5, 660, right around there. And, you know, versus bank loans or FinCo loans are 10 to 10-ish%. So you're 350, 400 basis points less, and it's fixed rate.
I imagine the loan mod market in a couple of years will be quite active for you guys.
Yes. So, and I know we're going to kind of talk about this. I'll jump right into it. One thing that we are able to do on HUD is typically, you know, when rates were in the 2, 3, even 4% range, you're doing a prepayment penalty of 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. So 10% in year one, declining by 1%, and no penalty thereafter. Because of the current rate environment, we've been doing a lot of flexible prepayments where it might be a 10, 10, 3, 2, 1, 1, 1, 1, 1, 1, 1, right? So people are estimating, okay, I think rates are going to stay high in the next 24 to 36 months, and then we'll start seeing a drop off. And so they want maximum prepayment flexibility because the penalty is a lot less. And obviously, when you do that, you have a non-conforming loan, right? So what we do is we take these loans and we sell them into REMICs, kind of like a mutual fund of other Ginnie Mae loans or HUD loans. And they all like the buyers like conforming loans, meaning everything should look the same. So when there's a bit of a difference with a prepayment structure, it changes their mathematical model, and therefore rates, they want a higher rate for that. So for non-conforming, that's a long way of getting around to saying that a non-conforming prepayment penalty might cost you 50, 60 basis points. So you might be paying in the low 7% range to have maximum flexibility in 24 to 36 months and beyond. But think about it, it's math, right? If you think rates are going to come down, I'll pay an extra half a point a year for the next year and a half to have a 3-point penalty in year 3 versus a 7-point penalty.
Yeah. Well, that kind of thinking has to be in play for many's acquisition strategies right now. So thanks for answering that.
Yep.
And just wanted to quickly touch on something I've alluded to before, but maybe Marc, I'll start with you. Have you noticed any problems out there? And you don't have to say among your own facilities, but have you noticed any problems out there with some of those facilities that were bought in 2021, 2022 with bridge debt that was low rate at the time, and those buyers had an intention of obtaining 3% HUD debt? Have you noticed any issues with those facilities now, or the high prices that were paid for them?
I mean, yes. Thankfully, I don't have that issue at Monarch, but I have heard others in the industry that have that are battling that and trying to figure out alternatives right now. Yeah, I mean, I know we're going to be talking about the future and things and the staffing issues at hand. One of the things that Akash brought up before was about the expenses. And you buy a facility, especially back in 2021, 2022, where you go in saying, oh, I'm going to cut this, I'm going to cut this, I'm going to save money here. And that's all fine and dandy, but either you didn't do that, or the interest rate just, got, skyrocketed and got you on that end. It's not as easy as it sounds. And I think a lot of people got caught in that fiasco where they're like, oh my God, how difficult could this be? And realizing it actually is that difficult. So yeah, there's definitely people in the industry that I've spoken to even over the last 3 to 6 months that are freaking out, not sure what to do. So I definitely tell them to talk to Erik and let him deal with that headache.
Thank you. Also, you've also had inflation, right, which has been astronomical. So all of your costs, not only staffing, first of all, there's no staffing available, right? So a lot of people had to go use agency, which is twice as much. You're paying $50 per hour versus 20 to 25. Your food costs have gone up, your housekeeping, your laundry, everything's just gone up. And also insurance is a real challenge these days as well. Insurance costs have skyrocketed, not only GL and PL insurance, but property insurance has gone up too.
Yeah. Well, all of those issues take me to my next question, which is for Akash. Could you just give an update on each of those kind of particular headwinds that the SNF industry is dealing with right now, and just whether they are kind of at their peak of awfulness, getting better, not as much of an issue right now?
Yeah, I can start with labor if that works for you. But I think labor shortages and wage pressures have been the biggest thing across the industry over the past year. What's really interesting about it is that what I'm seeing is that it's really disparate amongst different markets. For example, in metropolitan Nashville, I'm seeing a lot of agency labor usage across the facilities that I've looked at. But then when I look at rural Nashville, I'm not really seeing any agency labor usage at all, which I found actually very surprising given, metropolitan area versus a rural area. I also think, along the lines of the labor problems, I think union labor versus non-union labor is a big issue as well, especially in your states that have a lot of unions, and that's what a lot of operators are thinking about. Am I going to assume the union contract and move forward? And then so let's say another mandate or another issue or headwind that is plaguing the industry, and I know we'll talk about this a bit later, is just the CMS minimum staffing mandate. I think that's going to be have a big impact on the industry as well if it goes through. So I think a lot of operators are considering that as well.
Yeah. Do any of you want to kind of touch on the minimum staffing mandate, what you think possibly could happen, and
So
how it could be?
I mean, in my opinion, if this actually passes and goes through, there will be a lot less operators at the next conference that I go to. It's really scary. It's, I operate in Minnesota. There's 49 other states. There's several other countries. I don't think this is a Minnesota problem. I don't think it's an America problem. I don't know where everybody went. I was just talking to an intern who's getting into healthcare administration, and she asked the question of what's your most difficult and challenging part of the job. And, it's very easy to say staffing. Forget about the staffing mandate. Staffing is a big problem. I don't know, the number of human beings on earth keeps increasing, yet the amount of staff that we have decreases. Whether that's because everybody's working from home, everybody's sitting at the gym all day, everyone's sitting and watching all the different streaming channels, I don't know. But somehow we are losing a lot of staff. People who call me up and say, Mark, I love it. I love working there, but I can sit at home and really not do anything for the same dollar amount. So as long as that world continues where, yes, COVID let a lot of people work from home and some businesses never got back into the in-person work environment, some are slowly getting there. I'm hopeful that people realize they need money to put food on the table and come back to work and love what they do. But we're barely hanging on now. And if the staffing mandate comes through, or even a variance of that, we're in trouble. And that's whether you're a large operator, a small operator, it's scary. And in Minnesota, our rural communities sometimes do better than the urban ones, because if you live in this little town, you're working at this home. While in the Twin Cities, for example, or New York City or Chicago or Washington, D.C. or other large cities, there's so much competition that there are just not enough bodies that want to work in healthcare, whether you give them crazier increases. For the last 6 years, we've given larger increases than any other operator in the state, and we still can't keep up. So it's not just about the money. It's not just about the culture. It's about having the bodies that are just wanting to work. So it's scary if the staffing mandate comes through.
So Mark, what are you and all your business associates, are you lobbying against it? Is it, what's going on behind the scenes?
Yeah, I mean, there's a lot of lobbying. There's a lot of praying. It's definitely, I know we had a team that went down to Washington, D.C. a few months ago to meet with a lot of congressmen and senators and staff down there and other lobby groups. And a lot of the healthcare operators are partnering together to fight this. We're having our employees call the different representatives and going against this. I don't know. I think that the last conversation of, when they talk about reimbursement, and I remember when it was MDS 3.0 and when it was PDPM and the different reimbursements, is it going to happen? When's it going to happen? I have several staff that will remember me saying, oh, don't worry, it won't happen. And sure enough, they come through anyway. So we're fighting as hard as we can. Yeah, it's a challenging one.
Definitely muddies the waters for people's strategies, kind of looking forward to the next couple of years as well. And I just want to launch our first poll question for our audience right before the panelists address these questions, but let's get the first poll up. So as an investor in 2024, you would buy more SNFs, maintain your SNF holdings, sell some SNFs, or exit the SNF sector entirely. I'll have the panelists address this after we get our results back. But Mark, I just wanted to give you.
I want to know why. I want to know why we can't vote.
Oh, we'll know your answer afterwards, I'm sure. Exit the SNF sector. But Mark, I just wanted to give you a chance. Are there any other issues that we haven't addressed that operators are dealing with that investors need to be aware of?
Well, I don't want to shoo my investors away, but I think that the conversation for decades has been about census, right? And the need to fill beds. And that's obviously there, that's continuing to grow. But there is still that feeling of, I want to keep my mom or dad home. I want to find a place where they could get the better level care, the more individual care. And that's always a concern that we, argue with. And when I got into the industry 20 years ago, I'd say 70% of my population was the grandpas that you love and you talk to and have good conversations with that have now either moved down to assisted livings or even staying at home. While today the climate is, you walk in, you're going to see trachs, you're going to see vents, you're going to see G tubes, you're going to see a lot higher acuity patients coming to the nursing home. So it's just an interesting change. And I think that investors should be aware of that. That's also helped with the reimbursement though. Thankfully, the state and the federal government has helped us pay for those higher acuity patients, but they require more staff, and it goes back to that issue. So yeah, I think that it's still a growing market. I think that there are always going to be the need for skilled nursing facilities. And as long as you stand with the operators you trust and the relationships that you built, everyone will come out ahead.
Great. Well, let's close this poll, and I want to get the other poll up. Oh, well, no, let's look at the results first. All right. So the plurality of our audience says maintain your SNF holdings. That's at 47%. Next up was 25%, buy more SNFs. 20% of our audience said sell some SNFs. Akash, I hope you're listening. And then exit the SNF sector, 9%. So you guys have to work in the next 10 minutes to convince that 9% that they may be wrong. What do you guys think of that? So the majority want to either buy more SNFs or maintain their SNF holdings.
Well, I'll go first. I'm curious how many Monarch staff said to sell everything. But I really, and I said this before, I think if you're not growing, you're shrinking. If you're not, stability is great and keeping that right now, but with the growth forward, in order to look forward, you need to look at buying more and knowing that the industry is going to be there and need us. So I definitely support that. I'm glad to see that several people want to keep things the same, because that's great. I would love nothing more than everybody to continue operating, doing a great job, taking care of people. There's enough nursing homes, enough, to go around to keep everybody happy. The only times I'm buying is if somebody's selling. And usually that means that they did not do a good enough job. I don't know if I'm allowed to say that, but, or they're exiting the space altogether, retiring, you run into that a bunch. We've had success with that a lot of Minnesota. A lot of people changing their strategies of where they're looking toward assisted livings, toward independent livings. But a lot of times especially when I get homes from Akash, it's a lot of time distressed facilities and, looking for some help and some further guidance. So the people that want to get out, I'm here ready to buy. I think that Monarch is, along with a lot of other operators, have the resources to really provide great care. We call it 5-star customer service and innovative care at Monarch. And we just love smiling, and we love making people happy and feeling comfortable at home. And there's enough operators around the country that do that exact thing. And we're here for those buildings that, don't want to be there anymore.
Akash, what do you think about this? If you were an investor, how would you answer this?
Yeah, so I would say if I were an investor, I would definitely increase my acquisition activity. And the reason is, if you think about the past, right? If you look at during the COVID period, SNFs really proved to be a necessity to that healthcare continuum, and it really took pressures off a lot of the health systems, right? They really needed those nursing homes to serve those COVID positive patients, and that really proved. At the time, people thought, people were really scared about the industry as a whole, but the skilled nursing sector really proved to be a real necessity in that time period when everyone was scared. So I just think down the road, people have a very positive long-term outlook on the industry. And as a result, you've seen states increase their Medicaid budgets as well. And I think demand for this industry will continue in the long term. And at the end of the day, if you're in the business of acquiring SNFs, right, why wait? At the end of the day, your capital costs probably aren't coming down in the short term. Your labor costs probably aren't going down in the short term. But what is sure is that demand is going to continue in this industry over the next 20 years. So I think the best time is to actually increase your acquisition activity so you can ride the next 20 years and have your facilities ready to go.
And
I would guess that. Go on, Erik.
I was just going to add, if you look at cap rates, right? Historically, nursing homes have been trading at call it an average 13 caps for, 20, 30 years, as long as I can remember. That hasn't changed. And so I think in today's environment, if you find the right deal and it makes sense for a footprint and portfolio, you should definitely go after it. However, if cap rates in multifamily and other asset classes keep going up, right, it's going to create, you're going to have to think about, okay, do I want to kind of buy into a nursing home at a 13 cap, or which has a lot of moving, factors to a lot of factors go into running a nursing home. It's a very complicated business. Versus, I could buy this multifamily deal at a 7 cap or a 6 cap. We're not quite there yet, but we might get there. Where's my risk reward crossover? So that might change if cap rates keep going up in industrial, commercial, office, and multifamily.
Right. I just want to get our second poll up. We may run a couple of minutes late. But in 2024, which type of SNF would you rather buy? Profitable all Medicare private pay transitional care, traditional SNF that's covering its debt, but not much more, traditional SNF operating just under break even, or a vacant facility that you want to convert to an alternative use. And I also want to get to an audience question. Any of you can take this. How do you analyze and weigh the benefits of adding new ancillary service lines with the staffing challenges just discussed? Who wants
Mark,
that?
I think that's a you question, Mark.
I was just reading it. How do I analyze and weigh it? Okay, so I don't know. It's the ancillaries. I don't know. I don't see them making that much of a difference as far as different ancillary services. I mean, we're talking about therapy and pharmacy and other staffing companies. I try to do
different
everything
labor pool, different kind of work, maybe less burnout, perhaps.
Yeah, it's costs a lot more money. And we've tried to keep everything in the house. We create our own pool of staff. That's been really successful. Honestly, like from an operation standpoint, I'm just trying to gather my thoughts here. We really try to look in every avenue possible, whether that's an ancillary service, whether it's partnering with another group, whether that's figuring out things to do on our own. Some of them work, some of them don't. A lot of times a lot of ancillary services do have good pitches, so to say, and unfortunately can't deliver. I will say that there are several that have been awesome and they're a pleasure to work with. So it really varies. There's not once that I've ever worked with an ancillary service that I haven't thought immediately of how do I do this myself in-house. So it just, that's how I operate. We are one organization and we really try to partner with ourselves with that. But at this climate, anything that we could do to help the staffing challenge, we would definitely look at.
Right. All right, well, let's get the poll results up. All right, this is pretty even. So 21% want the profitable transitional care facility. 37%, the plurality, want a traditional SNF that is covering its debt. 31% want the traditional SNF that's operating just under break even, so a value add transaction. And then 10% want vacant, convert to an alternative use. What would you guys take as buyers?
Yeah, I can go first. I can take it first if you guys are okay with that. So I would say if it were me, I would go for the traditional SNF operating just under break even. I think that pricing that you're going to get is going to be attractive. And if I think I can truly improve the operations in the short term, I can realize that value for myself down the road, right? So I would say that's my answer. But one other caveat I would say is that the vacant answer surprised me a little bit. And at Blueprint, what we're seeing is a lot of nursing homes that have shut down recently or have had a lot of cash flow issues they're becoming vacant. We've had a tremendous amount of success here at Blueprint in marketing these vacant properties for alternative uses, for behavioral asset classes, detox, mental health, and things like that. So I think for a lot of facilities that are really struggling or vacant or need to shut down, there are alternative paths to consider. And we've had a tremendous amount of success with that over the past 12 months as well.
Mm-hmm. Mark, what about you?
Yeah. Yeah. So I mean, I personally, the price pays a lot more into this than any of the four options. But if I had to, choose it, obviously, well, I would love a profitable building that's kind of running on its own, but that's going to be more expensive. I don't mind something that's operating just under break even. I don't mind something that's even taking a little bit of a loss. I like a challenge. I like looking at, what we could do differently. But the obviously, if it's covering its debt and or if it's profitable, hey, that's a win. But you're going to know you're probably going to be paying a lot more money going in up front. And with the interest rates, that's pretty scary.
And Erik, do you have a choice?
If I were lending, it would be obviously have to be one of the top two, right? But as an investor, you have the most upside when you're able to come in at a takeover facility, which is just losing a little bit of money. And if you believe you could turn it around, there's a lot more upside on that than buying into a home that's performing at the, in maximum capacity with good census. There's really no value add to that. So if it was me, I would, just take choice number 3.
Right. Yeah, I think that's where I would go. But I just wanted to get to 2 last questions, and we'll do them pretty quickly. Akash, apples to apples, do you see prices going up or down for SNFs in 2024?
It's a good question. I would say I think prices are going to stay constant going into 2024, but similar to this year, I think deals will just take a little longer and be a little tougher to get done. But I think pricing stays constant.
Do you guys agree?
Yeah, as long as the interest rates are not fluctuating too much right now, I think they pretty much stay constant.
I've been waiting for a while for the shoe to drop with rates going up and people who didn't buy caps or swap out their floating rate debt. And we're just not seeing it. The market's still very strong.
Yeah, we've all been expecting some sort of wave, and it's been a constant trickle the last couple of years. Well, the last question, and I'll just go down the line. If you were the owner of a facility that is struggling to cover its capital costs right now, and you don't have much flexibility to hold on to it for many years, would you sell now or a year from now? Erik, do you want to start?
It all depends on the burn rate. If the burn rate is not so high, then I would not sell now. I would hold on to it. But if I couldn't afford it and it was causing, just too much stress and monetary commitment, then I would sell it.
And why would you sell? Why would you prefer to sell a year from now? You'd get a better value for it?
I think so. I mean, obviously, nobody wants to feed a facility every month, but I just don't think. I think the market, if you can hold on, I just think it's going to get stronger in 12 months from now, or even if rates start stabilizing and coming down. I think hopefully we're hitting a peak, but I thought that a few months ago. Rates keep going up. So what do I know?
Mark, you want to take that?
Yeah, I would really have to assess if I felt that facility had potential still, then I would try to hold on and say, okay, let's sell in a year from now. Let's try our best, give ourselves 12 months to figure this out. We see where our issue is. Let's figure it out and move forward and maybe come out ahead and not have to sell. However, sometimes you look at a facility and say, I don't see any hope. And you have to know that maybe it's the area that it's in is overbedded. Maybe the area it's in just opened a major Amazon distribution center and took all your staff and you can't even compete. And you have to know when you have a situation where you have to get out of. I'm going to add something besides for the option of selling now or selling later. There's an option there of closing the facility, which I think a lot of operators and investors are looking at and facing in real time right now and saying, I don't know what to do, because as much as they say, okay, sell now, and they choose that as an option, someone needs to be able to buy it. And based on our previous conversations of, is the price so crazy high? Is the interest rates too high? Sometimes there's a dollar amount that can't be reached by anybody. And they say, you know what? Especially if it's a home that's been owned for a while and maybe even debt-free. They say, I think we just have to close our doors. This is not doable. So it's a real conversation that a lot of operators are having, and it's scary, but it's something that we look at every day. And just thankfully, our portfolio is strong and doing great, and we're excited about it. But I know a lot of operators are going down that path.
Akash, take us home.
Yeah. So I would say, combination of what both Erik and Marc said, but if you believe you can truly increase your cash flow materially in the short run and have a clear path to do it, then I'd say, why not wait? You're likely to realize more value if you can increase your cash flow down the road. But at the same time, I would say if you don't think you can do that, I would say the purpose is, I think you should sell now. But one caveat that Marc brought up, which I found interesting, was the concept of shutting down your facility if you truly don't think you can make it work. There are alternative uses that you can find for your facility. So there are ways to increase your value there if you have to shut down your facility and sell it as vacant. So I'd say that's an interesting caveat as well.
Right. All right, you guys. Well, we are about 7 minutes over. So I think we have to end it, but we obviously can keep going all day long. But I just want to thank you all for a fantastic discussion today. There were no breaks at all. Lots of great answers. Really appreciate the time of all of you, the preparation time today, and then apologize for any of the audience questions that we did not get to today, but I will forward those on to our panelists, and we will get back to you with some answers there. I just want to thank our sponsor again, NewPoint Real Estate Capital, and also thank you, Erik, for being their representative today. Congrats on that HUD Lean ranking this year. Another great year for you guys. And also thank you to our audience. Again, if you could take a moment to fill out the survey that will appear following this webinar, we would greatly appreciate it. And that is it. Thank you all again. This was great.
Thank you.
Yeah, thank you all.